Hi, it's Bob Hoopshire, and this is the Gaining Perspective podcast, where we bring you insightful conversations with some of the top thought leaders in the investment advisor profession and investment management industry. I am the founder of Advisor Perspectives and a vice chairman of Vetify. My guest today is here to talk about an asset class that is often misunderstood. It wasn't until recently that investors had access to collateralized loan obligations, or CLOs. Institutional investors have benefited from the ownership of CLOs for over 25 years, and the asset class has grown to more than $1 trillion. These are not the same bonds that eroded the economy in 2008 during the global financial crisis. It's a similar name in the C-O, but a very different asset class. John Kim and his team at Panagram are experts in CLO investing. He is here to explain how CLOs work, why now for individual investors, the benefits of owning CLOs, and dispel some of the myths about this often misunderstood asset class. John will share what Panagram is doing to educate and explain why investors should consider an allocation. John Kim is the Chief Executive Officer and Chief Investment Officer at Panagram. He is the co-portfolio manager of Panagram's two ETFs, CLOZ and CLOX. So, John, tell me about your career path and what led you to co-found Panagram.
Hi, Bob. Thanks very much for having me on the podcast. It's a pleasure to speak about CLOs and our asset class. I started as an investment banker in the early 2000s, always specializing in structured credit and derivatives. I worked for a number of different investment banks, including Deutsche and the Texas, always in structured credit, mostly in CLOs. And as an investment banker, of course, you get to know structuring, the ins and outs, the nuances of the structuring, the asset class in depth, and you're doing a lot of issuance with a number of clients. So I've been in this space for quite a long time now. When Todd Bowley, who was the president of Guggenheim Partners, left Guggenheim, he started a company called Eldridge, and I joined Eldridge to run structured credit investing for Eldridge's companies, including an insurance company called Security Benefit Life. And ever since then, I've been helping this company to make investments, issue new investments in structured credit, and doing a lot of CLOs along the way. About 2 years ago, we decided to spin out and offer those same investment services to third parties, primarily in the wealth channels, and thus making our asset class available to wealth investors who had not previously had access to this. So we started Panagram to do that in 2021. And as you said, we've now issued two CLO back to express our view in that space.
So tell me more about Panagram. How big is the team there? What is your overall focus? And is it exclusively the two ETFs that you offer, or is there more?
Well, we run $15 billion in total AUM. So all of that is in structured credit. We are a specialized structured credit investor. About half of that AUM is in CLOs. So the ETFs today make up a pretty small portion of our overall AUM, but of course, we're hoping that they will grow. We have a 30-person team. Everyone here has had a career in CLOs or structured credit generally. I think one thing to note, Bob, it's important to know that we're not a manager of CLOs. We don't manage the underlying CLO structured vehicles. We do not manage the loans that go into CLOs, but we are a CLO investor. And as an independent CLO investor, we can be entirely agnostic as to the managers that we work with and who we choose to invest with. We've become one of the largest investors in the market in CLO equity, and we also are a very large investor in CLO debt, which is the focus of our two ETFs. So my team has been investing now together for the better part of a decade. We spun out of Eldridge in 21, as I mentioned, and we continue to support them, but we're now growing our third-party AUM fairly significantly. ETFs will be a large part of that for us.
And who are the clients that you serve?
So today, most of our clients are large institutions, banks, asset managers, insurance companies, multifamily offices that are institutional in scale. They come to us for the specialization that we have in structured credit and specifically in CLOs. Um, and now that we've, sort of pivoted to trying to offer some of the same services that we offer to our institutional clients on the wealth side, the ETFs are an expression of that. We also plan to launch a number of other wealth-directed products, including a closed-end fund for CLO equity and some interval funds in the future. As you said in your introduction, CLOs, although they've become a trillion plus asset class, are still largely misunderstood. And so part of our goal here at Panagram and the client base is to educate people as to why we think it's a good investment, how do we distinguish it, place it in our portfolios, what can it replace, what can it do for your return profile if you're a wealth investor and seeking to diversify your portfolio a little bit.
I'm going to ask you about those misunderstandings and what some of those are. But first, for the benefit of our listeners who may not be familiar with CLOs, describe the structure. How does it work? You mentioned earlier that there is a debt and an equity component. How do those all fit together?
Yeah, so I think the best way to think about a CLO is to describe it as an independent bank. So think about a bank that only has one function, and that function is to lend to corporate clients. So CLO is like a closed off bank. It doesn't have any other exposure except the loans that it makes to corporations. And a CLO, very importantly, funds itself with long-term financing that is locked in. So if you're a bank of this sort, a normal bank would have short-term commercial paper and a lot of different types of financings of different maturities, and then they would make loans against that. And hopefully, over time, they're able to roll their shorter-term financings and make their longer-term financings available to clients. But a CLO does the opposite. A CLO locks in long-term liabilities, and then it makes loans to individual clients. And it's a diverse portfolio of loans. It's not one or two loans. A typical CLO will have 150 to 300 loans in its portfolio. And these are loans to companies that, you've heard of. It's people like United Airlines and Hilton Hotels and Restoration Hardware. These are companies that are leveraged loan issuers. Those loans get made by this bank, the CLO, and then they're put into the portfolio and they perform in the portfolio. The CLO then collects all of the interest off the loans, and it pays off interest coupons for a bunch of debt investors. And the debt investors are ranked from AAA down to BB normally, and they get a stated coupon based on that interest coming off the loan pool. And at the very bottom of that, think about a shareholder of a bank. You're an equity holder. You don't have a stated coupon, but you get whatever is left over after all of the debt service is satisfied. So CLO works just like that. You have debt, people extending debt to the CLO in the form of rated tranches, which is what we buy in our debt book. And then there's also CLO equity, so the shareholders of the CLO who get the residuals. And we also invest in those tranches as well in different formats.
So I mentioned in my introduction that there are a lot of misconceptions about CLOs. One of them is that people immediately conjure up the images of the debt instruments that precipitated the great financial crisis. What are some of those misconceptions and how can you dispel them?
Well, I'm going to give it my best shot because people have been trying to do this for quite a long time, and it is confusing. CLOs are not CDOs. CDOs are the instruments that people think of when they think of the 2008 financial crisis. And if you've seen The Big Short, you know that CDOs were based on mortgages, individual mortgages. Remember that scene where Steve Carell finds out that this person that he's met in a bar has 8 houses. I mean, this is the type of mortgage flipping that was prevalent at that time, and of course, it led to a very bad outcome. But CDOs are really based on mortgages. CLOs are based on loans, as the name would indicate. And it's corporate loans. It's not individual loans to mom and pop businesses. These are corporate loans to larger corporations that are functioning, have a reason to exist, providing services to consumers, et cetera. So CLOs, actually performed quite well through the 2008 crisis. So it's a little unfortunate that we're always asked, oh, didn't they blow up in the great financial crisis? The answer is they did not. In fact, they had, on average, to equity holders in CLOs, there was a 15% average return. And the cumulative default rate for bonds that were rated in CLOs originated prior to the financial crisis was less than 1%. So CLOs actually performed not just okay, but they actually performed great. And relative to every other credit asset at that time, CLOs outperformed by quite a large margin. So it is hard to get away from the conception that CLOs somehow were caught up in the financial crisis, but the reality is they performed so much better than any other asset class at that time. And since that time, the market has grown. It's gotten more standardized. It's gotten more regulated. We've seen a lot of cleanup in the way that CLOs are produced and organized. So they've become even safer and better since the financial crisis. The aspects that led CLOs to outperform at that time exist today. And so CDOs are no longer, but CLOs will continue to exist. They'll really be. I think they should be part of most people's portfolios. One last thing, Bob, to remember is that CLOs were always actively managed vehicles. There is a loan manager, a professional loan manager, who selects the loans that go into the portfolio and manages that pool of loans over time. CDOs were static pools. You put the mortgages in, you left them there, and if they performed, great. If they didn't, then you start to write everything off. And that was a key difference that, again, led CLOs to outperform during the financial crisis.
Why an ETF now? Why package CLOs into ETFs?
The core reason for doing an ETF based on CLOs now is that we think that CLOs are the best risk-adjusted asset, probably in the entire fixed income universe. And because it's always been an institutional product, there was not an easy way for a standard investor, an individual investor, to access these types of assets. So we wanted to make the bonds available in a format that was very, very easy for your mother to buy. So there's no minimum in our ETFs. You can buy one share for $25 or thereabouts, and you can get exposure to a very, very diverse portfolio of CLO bonds that are giving off an incredible yield and also have a very, very low default record historically. So we think on the margin, very, very safe assets, but extremely high yielding at the same time. This is a very good risk-adjusted asset to have in your portfolio. Now, it wasn't until recently that we thought that CLO bonds could be appropriate for ETFs because when the market was smaller, they weren't as liquid. But the market's grown now. It's 1.2 trillion of outstanding paper in CLOs. Average trading volumes across the CLO market are about $15 billion a month. The investor base has grown very, very significantly since the global crisis. And, CLOs have really performed well through practically every crisis that we've had, not just the great financial crisis, but even through the pandemic, through the oil turmoil that we had around 2015, a couple of recessions along the way in the early 2000s. Over the 25 plus year history of CLOs in existence, they have had zero AAA defaults, like literally zero for the entire history of the market. And if you look down even at the lower rated tranches, the double B tranche, which is the first non-investment grade tranche that you can have in a CLO, the cumulative default rate on that is 44 basis points compared to a 15% default rate in corporate double Bs over that same time period. So you can see it's outperformed on the default side and you're also getting paid. So it's a very nice asset, we think, to have in everyone's portfolio. And the ETFs make that possible for people to put in, even if they only have small amounts to invest today.
And why did you choose an active ETF versus a mutual fund or an interval fund, like you mentioned earlier?
So our objective in making an actively managed ETF is to make it very easily accessible for both wealth and institutional investors. Now, we think the ETF for a long time probably was not appropriate for CLOs because the market wasn't as large and liquid as it is today. And also there weren't as many investors as there are today. But now, as I mentioned, the market is $1.2 trillion in outstanding paper. You've got hundreds, if not thousands, of underlying investors who specialize in this product. So we really think the market now will support a daily liquidity wrapper like an ETF. And we think that the underlying bonds are certainly liquid enough to provide daily liquidity, a great NAV calculation that's very reliable, et cetera, to the underlying investors. We like ETFs because they're so easily accessible to the individual investor. Just listed on an exchange, you can buy one share, no minimums. And although we do love interval funds, we think the interval fund structure is very, very compelling for certain types of assets that might not be as liquid as a CLO bond is today, such as CLO equity. We still think the ETF is the easiest way for an individual investor to get access to this type of asset class. So we just want to make it easy, accessible, no minimum, make it something that your families can buy and put into their portfolios very easily.
And it's active in the sense that you can buy and sell CLOs within the ETF. And then within each CLO, there's a loan manager who can be substituting loans.
That's correct. That's exactly right. The underlying CLOs are managed by professional loan managers. And then we pick the bonds that go into the ETFs and we actively manage those bonds.
So your two funds, CLOZ and CLOX, I believe they differ from each other in the credit ratings that of the loans that they buy. How do they differ from other CLO funds that our listeners would find in the market?
Well, I think the first thing to mention is that Panagram, as a manager of CLO assets, is a specialized manager. So if you think about it, we are CLO investors that issued an ETF. We're not an ETF issuer that is now morphing into CLOs. This is our asset class. We've been in this asset class a long time and we know it very, very well. When we started to look at the wealth universe and how can we get people access to this asset class, we thought the ETFs were a good expression of what we already do on the institutional side. Remember that we run approximately $6 billion in triple B and double B debt, which is the focus of CLOZ, our mezzanine ETF. And we run quite a lot of money also in the AAA portion of the CLO, the safest part of the CLO, which is expressed in CLOX. So we have a lot of experience in this market. We trade in it every single day. So the ETFs will be an outgrowth of what we're already doing in our daily lives as asset managers in structured credit. And we think that that we're going to bring that expertise, right, to the individual investor. We're not just adding another flavor of ETF to a bunch of different strategies. We're starting with our strategy and then expressing that in an ETF side. So we do think it takes a lot of experience and expertise to navigate this particular asset class, just given its specialties. So that's the reason that we start to issue these ETFs in that format.
And I believe the expense ratios are 20 and 50 basis points for the AAA CLOX and the lower rated CLOZ. Is that correct?
That's correct. CLOX, AAA, 20 basis points. CLOZ, double B and triple B bonds, 50 basis points.
And what are the risk control measures that you have for them? For example, how are they diversified across industry or across other dimensions?
So we have a very diversified portfolio of CLO bonds, which in turn express a portfolio of underlying loans that is extremely diverse. Remember that CLOs themselves have a lot of diversity rules embedded in their portfolios. So you can't over allocate to one industry, for example. You can't over allocate to one issuer. You must diversify in your loan pool. Similarly, in our ETF, we have a very diverse pool. So I think there's 60 bonds, for example, in CLOZ. And what we've done here in terms of our active management strategy and risk control is to use our expertise in the market to limit our investments to very, very high quality managers. And by high quality manager, I mean not only a manager that has a great loan track record, but a manager who has sufficient scale to truly monitor the entire loan market, to have enough people to do workouts in case loans do go sideways or start to have issues in the credit markets, and also someone who has a large following in CLO bonds, because liquidity for us is a really important bedrock of these ETF products. We need to be able to give people their money back on a daily basis, and so you cannot put that kind of capital into a tier 2 or tier 3 manager. So our risk controls are to diversify heavily, to make sure we're not overexposed to any one particular style of management or loan portfolio, but at the same time to use our expertise to identify who the best issuers are that we can source for the ETF.
How should advisors think about allocating to one of your ETFs? You mentioned earlier that it has a very attractive yield in the universe of bonds. Is the allocation that you see typically coming from the bond allocations that advisors are holding?
Yes, and the interesting thing is that initially, when people look at CLOs as an asset class, they think of it as a real alternative, and they think of it as a tactical kind of shift. If spreads widen a little bit, or if I can get more interest rate here, then I'm going to allocate something to CLOs. But when they hear the entire story, and we're able to sit them down for 5 minutes and give them the whole run through as to why CLOs have performed so well over time, they realize, okay, this shouldn't just be a tactical investment. This should be a core holding in my bond portfolio. Maybe it should replace some portion of my overall bond exposure, especially in high yield. And there are three reasons for that, right? I mean, there's great income coming off of these ETFs and the underlying CLOs portfolios. It offers a lot more yield than similarly rated corporate exposure. So for the rating, you're getting paid a lot more in yield. You have better downside protection. If you look at the historical track record, as I mentioned before, very low default rates in CLO bonds versus similarly rated corporates. So you're getting better downside, more capital preservation. And then in terms of diversification in your individual portfolio, CLOs actually have a very low correlation to public equities, public bonds. So if you have a standard 60-40 portfolio, or you've been putting most of your money into equity mutual funds, this is a great diversifier. It diversifies you away from those public markets into an alternative market that is very liquid, very high yielding, great downside protection. So we think it should be a part of everyone's portfolio. And it's certainly, I think people are starting to awaken to that notion, because we've been seeing a lot of inflows from the wealth channels.
You mentioned high yield. What are the SEC 30-day yields now on the two ETFs?
Yep. So the CLOX, which is our AAA one, is 6.65%. And the CLOZ, the MEZ one, is 10.67.
What is the argument for CLOs now? What is the economic or market imperative that makes these so attractive?
I think one of the interesting things about CLOs that people haven't understood very well until recently is that they're floating rate. We've been in an environment where obviously rates have risen very significantly over a short period of time, and CLO investors have actually managed to capture all of that rate rise in excess yield. So that's why some of the CLO bonds now are yielding so much. I mean, when you have Fed funds rates at 5.5, you want to capture that yield. You don't want to just leave it on the table. If you're in a typical high yield bond portfolio, which is a largely fixed rate portfolio, of course, your price goes down. You're still clipping the same coupon you were before, but now your portfolio is worth less because rates have risen. If you're a CLO investor, you've captured all of that. Now, we can't predict what the Fed will do, but I think there's a consensus in the market that we're going to be at higher rates for longer. It's pretty clear that inflation is fairly embedded. It's not going away tomorrow. So what we would say is you're still going to be clipping a very nice yield here with high rates. And if rates go up a little bit, you capture that. And if rates stay higher for longer, you're still capturing that yield. It might be a nice time to diversify into some fixed rate to increase your interest rate duration at a time like this. However, having CLOs as a core part of your portfolio means that you're always going to be capturing a great credit spread relative to other rated assets. And that's going to be something that holds you in good stead, even if rates start to go down later. So we think that's a great argument for CLOs in general. People have ignored, or it hasn't been easy to get access to floating rate bonds in the past in any format, and CLOs are a great expression of that.
Is there an economic scenario that you worry about that would threaten the performance of the ETS? For example, if rates continue to rise, would that threaten the debt servicing ability of some of these issuers?
Yes, 100%. We are worried about it. Of course, as asset managers, our responsibility is to try to mitigate that downside for our investors. It is a clear concern because obviously as rates rise, debt service becomes more complex for a lot of the companies that are leveraged loan borrowers. One thing that we can look at, and we've been surprised at the robustness of the response by corporate loan borrowers to the rate rises. We look at the default rate of the overall loan market, and that has ticked up to about 1.55% on an annualized basis. That's not a particularly high number historically. Generally speaking, loan defaults have ranged between 1 and 4%, sort of, on average over the last 20, 25 years. But, it is ticking up. It was like closer to zero a few years ago. And, we're seeing an increased number of corporate bankruptcies. Of course, a lot of them have been in the news. So, of course, we can't ignore that. But I'll say two mitigants to that are, number one, recoveries on loans traditionally have been very high. You don't lose necessarily 100% of your investment if your loan defaults. Many times, loans being senior secured and first pay assets in a corporate capital structure will recover some portion of that investment back. So don't think of a loan default as a zero recovery. Traditionally, it's been 70%, and even if it's less than that in the future, you're getting some portion of that money back generally in most cases. The second thing to realize is that CLOs, remember that I referred to them as being a closed bank. It's also a closed bank with rules. CLOs just can't invest in everything. They can't just buy whatever they want. It's not meant to be a trading strategy or a momentum strategy. It's not meant to be a distress strategy. You're not supposed to buy triple C loans generally. You don't buy a bunch of discounted loans and try to make up, money on the price. They're really supposed to be buy and hold vehicles for credit that you want to put in there and live with for a long time. So as a result of that, CLOs cannot buy the overall market and don't have the same default rate as the overall market. So whereas I mentioned before that the loan market is experiencing a 1.55% default rate right now, CLO portfolios are at around 60 basis points, so 0.60% compared to the 1.55. So it's much lower. They don't have the same kinds of exposure in triple Cs and other distressed things, and so they're really able to withstand, we think, a rising rate environment much more steadily than the loan index.
Where can our listeners go to learn more about Panagram and your ETFs?
Well, we have our websites, cloxfund.com and clozfund.com. And if you look on our Panagram website, our core website, p-gram.com, you'll see links to all of those ETFs. And, that's the best place to get information on our offerings.
And we will include those links in the notes that accompany this podcast. If there's one key takeaway that you would like to leave with our audience of advisors about the diligence that they should perform on a CLO investment, what would that be?
I would say look at CLOs in the context of their historical performance, compare them to other rated assets that should be of similar credit quality. And I think what they will see is that CLOs on a risk-adjusted basis are a very, very compelling asset class to allocate some of your funds to. And we believe all investors, from small to large, would benefit from some exposure to this asset class, just given the performance and the yields today.
Well, thank you. And as I mentioned, we'll include a link to the Panagram website and to the two fact sheets on the ETFs that John has mentioned, CLOZ and CLOX, that'll all be in the notes that accompany this podcast. John, is there anything else you'd like to add?
No, Bob, thanks very much for having me on, and we hope that investors will be able to go on the websites, get the information they need, and if not, they can shoot us an email and we'll try to respond.
Well, thank you, and thank you for listening to the Gaining Perspective podcast with Bob Hoopsher, today featuring John Kim of Panagram. To support our podcast, please share, subscribe, or leave a review to help make our podcast more findable for your friends and colleagues. You can subscribe to Gaining Perspective on your favorite podcasting service.